A 620 credit score versus a 720 credit score, same mortgage, same house, same down payment. The difference? $47,000 over 25 years. And here's what nobody's telling you. The advice you're following right now to improve your credit, it's probably making it worse. I'm going to show you 5 factors that actually control your credit score in Canada. And the one mistake I see homeowners make over and over again that cost them thousands, sometimes tens of thousands in higher mortgage payments. And if you're planning to refinance, buy a home, or access equity, what I'm about to share could be the difference between getting approved for a 3.99 interest rate versus a 5.2% interest rate. Let's get into it. I'm Dion Williams from Williams Mortgage. I work with Canadians all across the country helping homeowners get mortgage free faster. And I've seen firsthand how bad credit advice destroys people's ability to refinance, consolidate debt, or access the equity they've built in their home. So here's what we're going to talk about today. I'm going to go through exactly how credit scores work in Canada. Not the generic advice you'll find everywhere else, but the real information that matters when you're trying to get a mortgage or save money on the one you already have. And if you want to chat about your specific situation, click the link below and book straight into my calendar. And while you're at it, hit that subscribe button so you don't miss any updates. All right, let's get into it. Look, there's two pieces of advice out there floating around that are doing serious damage to Canadians' financial futures. And chances are you've heard both of them. The first, credit card hacking, where you apply for multiple credit cards to chase reward points and free flights. The second, using those free credit score monitoring apps that promise to help you track or protect you. Both of these, they're hurting you more than helping you. And here's what most people don't realize: the companies giving you free credit monitoring aren't doing it out of the goodness of their heart. They're doing it because they know that statistically, you're going to end up borrowing money from them. If something's free, you're not the customer, you're the product. These apps are using data to sell you credit cards and loans. And credit card hacking, it requires you to constantly apply for new credit, which absolutely tanks your credit score over time. Plus, the more credit you have available, the more you're tempted to use it. I've seen this play out at dozens of times. Someone comes to me, they've been chasing rewards, and now they're sitting on $40,000 worth of credit card debt, and they can't qualify or refinance for the actual home that they want. So, let me give you the right way to do this. Before I show you how to actually monitor your credit the right way, you need to understand something critical. Not all credit scores are the same. See, there's Equifax and TransUnion. Those are the two major credit bureaus in Canada. They have each different ways of calculating their score, and it gets even more complicated. Each of those companies have different algorithms depending on who's asking for the credit. So the score you see for the free app, that's different from what bank sees. And it's different from what I see as a mortgage broker. We use something called a beacon score. It's the latest version of the credit scoring algorithm. It weighs certain factors more heavily than others. So when you're monitoring your credit, you want to go directly to the source. That's equifax.ca or TransUnion. So, yes, you have to pay for it, but you're getting accurate information directly from the credit bureau, not the middleman trying to sell you something. Now, once you know your score, the next question is what actually affects it? And more importantly, what can you do about it? Let me walk you through the 5 factors that determine your credit score. And I'm going to explain each one in context of how it actually affects your ability to get a mortgage, refinance, or access the equity in your home. This is a big one. Your payment history makes up 35% of your credit score. And it's exactly what it sounds like. It tracks your record of making payments on time. Now, here's what most people don't know. If you miss a payment 1 or 2 days, that's not going to show up on your credit report. You actually have a 30-day grace period. So, if you're a day late, don't panic. You're fine. But if you miss a payment by more than 30 days, that's when it shows up as a late payment. And that late payment will stay on your credit report for the next 7 years. Let me break down how this works. Credit bureaus use a rating system. An R1 or an I1 means you're paying on time. An R2 or an I2 means you've missed a payment by 30 days. An R3 means 60 days or later, and so on. The R stands for revolving credit, things like a credit card and lines of credit. The I, that stands for installment credit, things like car loans, personal loans, where you have a fixed payment every month. Now, if you get to an R6, which means you're 180 days late, that's where lenders typically sell your debt to a collection agency. And once it goes to collections, it's marked as an R9, which is the worst rating you can get. And here's why this matters for homeowners. If you're trying to refinance your mortgage to consolidate debt or access equity and you've got late payments on your credit report, you're either going to get declined or you're going to have to pay a much higher interest rate. We're talking potentially 2 to 3% higher. On a $300,000 mortgage, that could cost you an extra $500 to $700 a month. Over 25 years, that's $150,000 in interest. So, the number one thing you can do to protect your credit and your ability to access better mortgage rates is to make your payments on time, every single time. Now, let me talk about collections for a second, because this is where I see people make a huge mistake. The two most common collections I see on credit reports: cell phone companies and ambulance bills. Here's what happens: someone gets into a dispute with their cell phone provider. Maybe they've gotten overcharged, so they decide, I'm not paying this until they fix it. And then the cell phone company sends it to collections. And now it's on your credit report for 7 years. Here's my advice: pay it first, then fight it. I know it feels backwards, but trust me, protecting your credit is more important than winning a $200 dispute with Rogers or Bell or TELUS. Pay the bill, keep your credit clean, and then dispute it after the fact if you need to. Because here's the reality: you're not getting a mortgage or refinance until that collection is paid. The collection agency, they know this. They know you need good credit to access your home's equity or get a better rate. So they will get their money eventually. Don't let them destroy your credit in the process. This is the second biggest factor in your credit score, and it's one that's increasingly important in the recent years. Your credit utilization is the ratio of how much credit you're using versus how much you have available. This accounts for about 30% of your credit score. Here's an example. So let's say you had a $10,000 line of credit and you're consistently using nine or $10,000 of it. What that tells the credit bureau is that you're maxed out and that you might be in financial trouble. What they want to see is low utilization. If you've got a $10,000 available, they want to see you using maybe $2,000 to $3,000. Now, why does this matter for your homeowners? Because when you're trying to refinance or access equity, lenders look at your credit utilization as a sign of financial stress. If you're maxed out on your credit cards and lines of credit, they're going to assume you're struggling and they're going to decline you or charge you a higher rate. So here's the fastest way to improve your score: pay down your credit cards and your line of credits. Within 30 to 60 days, you'll see your score start to climb. Now, there's another strategy people talk about, which is applying for more credit to increase your available credit. And yes, technically, if you have more credit available, You're not using it, your utilization ratio improves. But here's the catch: if you're already at high utilization and you start applying for more credit, the credit bureau sees that as a red flag. They think this person's in trouble and they're scrambling for more credit. And that can actually hurt your score more than help it. So, my advice: focus on paying down what you owe. That's the safest, most effective way to improve your utilization ratio. Now, there is one exception. If you get a pre approved credit card offer, one where they say no credit check required and there's no fees, go ahead and accept it. That will increase your available credit without triggering a hard inquiry. Just don't use it. This one is pretty straightforward. The longer you've had credit, the better. Credit bureaus want to see that you have a long established history of managing credit responsibly. So if you've had a credit card for 15, 20 years, that's a good thing, even if you don't use it. Here's a mistake I see all the time: someone upgrades to a new credit card with better rewards and they decide to close their old one. The old one you've had since you were 18. Don't do it. Keep that old card open, even if you're not using it. It's helping your credit score by showing a long credit history. The same goes for lines of credit. If you've had a line of credit for 10 years, don't close it just because you're not using it. That history is valuable. Public records include things like bankruptcies, consumer proposals, and collections. And while this only makes up about 10% of your credit score, don't let that fool you. If you've gotten to the point where you have a public record on your credit report, there's a good chance a lot of other things have gone wrong too. You've probably missed payments, you've probably got high utilization, and at that point, your credit is in very serious trouble. Now, I want to talk to you about consumer proposals for a second because there's a lot of misinformation out there. Consumer proposal companies will tell you that consumer proposals are better than bankruptcy, that it won't affect your credit as much, that it won't hurt your ability to get a mortgage. That's not accurate. A consumer proposal affects your credit just as much as a bankruptcy. It makes it extremely difficult to get a mortgage. And if you do qualify, you're going to have to pay a much higher interest rate. So if you're considering a consumer proposal, I want you to understand it's not a magic solution. It should be the last resort. Something you only do if you absolutely have no other option. If you're a homeowner with equity in your home, there are often better options. You might be able to refinance your mortgage to consolidate your debt at a much lower interest rate. That's the kind of scenario I help people with every day. So before you go down the consumer proposal route, talk to a mortgage professional. There might be a better way. And this is the most misunderstood factor, and the reason I'm so opposed to credit card hacking. Every time you apply for credit, whether it's a credit card, a loan, or a mortgage, the lender does a hard inquiry on your credit report. And those inquiries can hurt your score. Now, here's what people get wrong. They think if you apply for a mortgage with multiple lenders, it's going to destroy your credit. That's not true. Credit bureaus are smart. They know that when you're shopping for a mortgage, you're going to apply with multiple lenders to compare rates. So if you apply with 3 or 4 mortgage lenders within a short period of time, let's say 30 days, those inquiries are all counted as one. So, yes, you have the right to shop around, and you should. Applying with multiple lenders to get the best rate isn't going to hurt your credit in any significant way. What will hurt your credit is applying for credit over and over and over again when you don't need it. That's what credit card hacking does. You're constantly applying for new credit cards, and each one of those applications, it's a hard inquiry. And over time, that adds up. So here's my advice: only apply for credit when you actually need it. If you're shopping for a mortgage, apply with a few lenders and compare your options. But don't apply for credit cards you don't need just to chase rewards. It's not worth the damage to your credit score. Now, let's talk about what actually constitutes a good credit score in Canada. If your credit score is above 680, you're in good shape. That's going to get you the best mortgage rates, the best terms, and the most options when it comes to refinancing or accessing your equity. Between 620 to 680, things get a little trickier. You're probably still qualifying for a mortgage, but you might not just get the absolute best rate. And depending on your situation, you might face some limitations on how much you can borrow. Below 620, that's where it starts to get difficult. You're going to pay a higher interest rate, and some lenders won't work with you at all. If you're between 550 and 620, the good news is you can improve your credit score with some focused efforts, but it's going to have to take time. And if you're below 550, you've got a lot of work ahead of you. You're probably looking at 7 to 10 years to rebuild your process, and you need to be diligent about making every payment on time and keeping your credit utilization low. So let's wrap this up with the key things you need to do to protect your credit, especially if you're a homeowner or you're planning to buy a home. First, make your payments on time, every single time. Second, keep your credit utilization low. Aim to use less than 30% of your available credit. Third, don't close old credit cards or lines of credit. Fourth, only apply for credit when you actually need it. And fifth, if you're a homeowner and you're struggling with debt, talk to a mortgage professional before you do anything drastic like a consumer proposal. There might be better options out there like refinancing your mortgage to consolidate your debt at a lower rate. By the way, if you're watching this and thinking, I wonder if my credit's holding me back from refinancing or accessing your equity, click the link below and book a free call with me. I'll review your situation, show you exactly where you stand, and walk you through your options. So, if this helped you or you found value in this, please hit the like button and the subscribe button and hit that little bell. And if you do want to book a call with me to see how we can restructure your payments, to see if we can pay off some debt, or just look at your situation in general, click the link below in the description and you can book an appointment with me directly in my calendar and we'll meet on a Google Meet. Thanks for watching.